Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I want to welcome everyone on all the major podcast platforms and also people that are looking at the stunning good looks of my guest on the YouTube channel, Fun with Annuities YouTube channel. I'm so happy that Owen Schrum is back with us. Owen is one of the top individual money managers in the country. He works with consumers, just like I do, one-on-one. So I'd encourage you to go to Schrum, SCHRUMPW.com, and that will be on my site. Don't worry about writing that down. But the reason I want to have him back on is, number one, he's been doing this a long time, taught me everything that I know about the stock markets, etc. Full disclosure, I used to be partners with Owen at Morgan Stanley a long, long time ago. And, he's just a really good friend. But throw the friendship aside for a second. He is a bad dude when it comes to money management. He is really, really, really good. And I encourage you, for any of your non-annuity type thoughts, you need to at least interview him, have a conversation with him, because he's really, really good at what he does. So with that being said, Owen, welcome back to Fun with Annuities.
Oh, it's good to see you again. Thanks for having me on, Stan.
Absolutely. And as I was saying before we got on the broadcast, Owen went to University of North Carolina, Chapel Hill. So that's the reason I have the Carolina Blue baseball cap on. He considers Chapel Hill to be sacred ground. He might be right. It was when Dean Smith was there coaching basketball. It might not be as sacred now, but no, he's a good friend, and we share a lot of outside things together, music and basketball and things like that. But I wanted to have you on, Owen, because you have access to people that we the peons out here do not. I mean, you're talking to people like Jeremy Siegel and Byron Ween, and you have those connections and those insights from those people that have been in the business for decades and decades and decades. And we're in weird times, obviously, but I wanted to get your take. Start where you want to start, and then we'll just go from there, because I want to hear your thoughts on current markets and what's going to happen. Hopefully you'll have some insight into 2022.
Yeah, thank you. I want to explain first where I put together this list. We started about 5-10 years ago. 35 years in the business. The main thing we've learned, there are some really, really smart professionals out there. Not the ones you always see on CNBC or doing commercials. The ones that are managing big institutional monies. The economists, Dr. Siegel's, Byron Ween's, Henry McVeigh at KKR. And there's, for all of the bad information, there are tidbits of really smart strategists that give us information that makes people money and helps them protect their money. So we gather that information from these people at the end of the year, and January 1st, we put out our 2022 outlook, but it is driven by the consensus of what these really smart professionals are giving us from an information point of view. So I'm going to go over it because it's playing out. Now, remember, as I give you some of this information, Stan and the audiences, we put this together January 1st. So this is building through the fourth quarter. And the first thing they said was, number one, we are going to see a big increase in volatility this year. And you're going to see at least 2 corrections in 2022.
Define correction.
A correction is when the market goes down 10% or more in the short term and comes back.
Okay.
As opposed to a bear market, which is 20% associated typically with a recession and can last years.
Owen, do you believe that they are actually going to raise rates? And if you say yes, then you believe in humanity, and I like that. But if you say yes, then how are those supposed alleged potential increases in the interest rates, how's that going to affect the stock market and people's investments?
They are going to raise interest rates, in our opinion, 3 times this year and 4 times more next year. Our opinion is that will be 25 quarter points each time, but 7 increases. We're changing it. The word we're getting out now is they may announce this week that they are going to raise interest rates at the end of March. Our original thoughts are 3 times in the fourth quarter. They may start early. The answer is yes, they are.
And why all of a sudden is the Fed autonomous and doing what they're supposed to do, whereas before with previous administration and this one, it seems like they're being bullied? I mean, the Fed should be standalone. That's why they're there, but they certainly haven't acted like that over the last 5 to 6 years. Why all of a sudden, are they flexing their muscle here when they should be?
Well, great question. And Dr. Siegel from Wharton made this point last year that the Fed was behind the curve. They needed to raise interest rates, but being political animals, they would not start until Powell was reconfirmed this year. He has been reconfirmed for 2 more years. He is a lame duck Federal Reserve
He's
chairman.
a lame duck with a heck of a lot of power.
A heck of a lot of power, and also they are behind the curve. Now, rightfully so. No one knew where this pandemic was going to take us last April. No one knew. And they have put in the greatest amount of liquidity, meaning cash, money, into the financial markets in history, greater than post-World War II. 25% increase in M2, which is the amount of money that can.
Yeah, we printed so much money.
That's exactly right.
Unbelievable.
And if they don't do something, we could be looking at hyperinflation.
But Owen, if they raise interest rates, aren't they raising interest rate payments on themselves? They the government?
Well, they aren't the government.
Yeah, no. What I'm saying is, if the Fed raises rates,
yes,
then all of this debt and all of this printing of money, and all of the things that we owe as a government, those payments are going to go up. I understand that it should be autonomous, but that's where my conspiracy hat comes on and go, man, I think the pressure after the first rate increase will be so huge and heavy that they'll come off of it. You're saying they're not going to come off of it.
They can't come off of it.
Why can't they come off of it?
Inflation printed 7% last quarter alone.
Right. I mean, 7% is a big number.
And 5% next year, 5% the next year. We're looking at a 20% increase in inflation over the next 3 to 4 years. And that's baked in. It's too late to change that.
There's nothing my boy Biden can do about that, right?
You can't just. Our economy is.
He's not my boy, by the way. That was.
I did.
That was a joke.
I have to really walk a fine line.
Yeah, I mean, we're not political, but what you're saying is there's nothing he can do.
There's not.
It's coming.
And if they don't stand, it's quite possible without raising interest rates, we could look at hyperinflation that could force a devaluation of our currency. We can't be Argentina.
So they have to. Fed has to do this.
They have to do something.
Honestly, I like hearing this because, I'm a planner. I'm a box checker just like you. And most of my clients and people out there listening, they are as well. Or else why the heck are you listening? You're trying to get some insight. But what you're saying is bank it. I mean, these rates are going to go up because they have to go up, because if they don't go up, we're screwed, right?
That's exactly.
Is that the Southern version of it? Oh.
That's Southern Fed talk.
That's Southern Fed talk. We're screwed if we don't do this. I'm going to tell you that right now. And people laugh all the time because I have this mythical person named Chester that is the guy that for me and you, Owen, Chester is our uncle at the family reunion this way. Let me tell you something, boy. The Fed better. Let me tell you something, son. That Fed better raise rates or all heck's going to break. That's Chester talking about the Fed. But that's
Chester's
interesting.
right.
So inflation is going to continue to go up, which means the media is going to go crazy, which means that there will be a change of power regardless of what idiot is running on either side. So it's going to happen, but in 2 years, so inflation's gone up. What happens then? What are the smart people in the room like you saying?
Okay, this is history redone, and it's eerie how accurate this replays itself since the 50s, the 60s, the 70s, and the 80s. Nothing is the new normal, Stan. Nothing. So history shows. Everyone thinks the Fed raises interest rates, the market's going to crash. So understand, interest rates were 0.8% a year ago. 0.8.
I know.
They average 5. So they're going to talk about raising interest rates. People are going to sell, which is what's happening right now, because they're going to find out they're going to raise. They realize now they're going to raise interest rates. We're having volatility. They're going to sell. And then they're going to realize, wait a minute, they're raising it 25 basis points to 1.25%. And why are they doing that? It's because the economy is growing so fast. What happens when the economy grows fast? Earnings grow fast. Earnings are the lifeblood of the stock market. Stock market is nothing but a company's earnings plus its dividends. So when the earnings go, they finally say, okay, they're going to raise it to 2%. Big deal. And earnings are going to come in at 12% increase this year, which is enormous. And that's another one of our consensus beliefs. So the market continues. And our consensus is for 2022, starting from January 1st, not right now, that Dow is going to go up 5%. S&P is going to go up 7%.
That's 2022. But it's still north. We're still headed north, even with interest rate increases.
Now, here's the next step. This is what history also shows us. The Fed always raises interest rates too much. They always do. So
why is that? Why do you know that and they don't know that?
Because it's just something you can't time. It's almost the remedy is, okay, let me give you that's a terrible analogy. When someone has cancer, what do you do with chemo? Chemo is killing the cancer, but it makes the patient sick also. You don't know exactly the right amount, correct? You do know you have
that actually is a actually good but morbid example.
It's sad, and I hate to say it that way. It points out it's an inexact science. They have to slow the economy, or you have hyperinflation. They don't know how much that is until Feds are. They try to say it's forward-looking. It's backwards-looking. They raise interest rates until the economy stalls. A recession happens, and it's a cycle that starts again. So typically, historically, market hiccups, you get a sell-off, then people figure it out. The markets go up as they raise interest rates. They raise them too much. The economy stalls. Then we have a recession. Then we have a bear market.
And on these 7 interest rate hikes that you are predicting, you and your smart people, over the next 2 years, you're saying 25 basis points, 1/4%. What are you saying? What is the levels that they're going to do? They're going to tiptoe in?
Yeah, they're tiptoe. Yes, they're going to tiptoe in as if, and they're not going to come in with. They might come in with 50 basis points, half a point, but they're not going to do 75 basis points. They're not going to do 1%. No. They're going to do 1/4%, see how it takes. Do 1/4%, do 1/4% until the economy starts slowing down, inflation stops. Now, understand the United States economy is like one of these giant cruise ships. You just can't put a brake on it and make it turn. It's not a sports car. It's a
cruise ship. Turning a cruise ship around in a port. If you ever been on a cruise ship. That's
exactly right.
Yep.
So even when they apply this, they don't know when it's going to stop. So they keep doing it until they get it going in the direction they want. Unfortunately, that usually causes a recession. Unfortunately, recessions cause bear markets. That's what history shows us. But we're looking into 2023 for events like that.
So not raging bull market over the next 2 years, but bull market with interest rates rising sounds pretty good, Owen Schrum.
For 2022, the consensus we're seeing is, remember, I don't know if I mentioned this before, 2 corrections in 2022.
And define, if we've done this before, I apologize, but a correction is what again? Definition?
Correction is a short-term decline, 10% to 20%.
That's what I thought. Yeah, and so that, I mean, in these volatile markets, that could happen in a day, in a week, and whatever. And you had a good point when I talked to you previously. this week was about, hey, we're at Dow 35,000, so, or ish, wherever you want, wherever it is at the time of this taping. It's not like the Dow's at 1,200.
Correct.
When we started back in the day,
The
because as
400
we say, we have cowboy boots older than most investment advisors out there. And hold that thought for a second, because I want to ask you this. Because most of these advisors are young and green and haven't seen a down market and just think that everything's going to go up, is that going to affect the markets negatively? Or, I mean, are you going to see some problems because most people haven't seen a down market? Most advisors?
My concern is short-term and long-term. Remember, we started this off as our people say that we're going to have increased volatility.
Right.
It's because a lot of people, both professional and individual, haven't seen this before, and they're going to react emotionally. That's going to create the volatility. My concern is people who are new investors are going to suffer their first correction, maybe their first bear market, and they're going to be like our great grandparents who in the Depression never took the money out of the jar in the backyard again. They're going to abandon stocks for years to come, and they're going to surrender one of the great wealth creators America has.
Well, and I think that we're seeing that kind of play out right now, real time, with the people that weren't sophisticated that bought crypto. And they're coming in, they're getting, they bought it at the high. It's half the value. They're panicking. I'm reading stories they're tragic and funny at the same time about people that thought they were rich and all of a sudden they're not rich. And also too, people that are using margin that aren't sophisticated to use margin to buy things. Like I read somewhere where a lot of the crypto purchased is margined with crypto. So do you see crypto, and we've talked about crypto in the past in one of our previous podcasts, where you really succinctly and clearly explain blockchain technology, and I appreciate that. But do you see crypto being an outlier to these predictions that because it's blue water and we've never seen it before, could that throw a wrench in the engine?
Yes.
Good answer.
Good point. Yes.
Expound, my friend.
That was next. So crypto was first presented as what? A new currency.
Correct.
And I think it's proven to many that that's not going to be the case. Who wants to take their paycheck in a currency that may go down 40% before they get their next paycheck?
A couple of dumb people did it last year. And as you predicted, by the way, you predicted this last year. You said, hey, Stan and listeners, the United States government's going to get involved in crypto. And when they do, it's game over for a lot of these dreamers out here that are creating their own or have their own crypto. I mean, you were on the money, spot on. And just recently, there was an announcement that the United States government is now looking into crypto. And me and you both know why. They can track us and they can tax us real time. And there will be no more April 15th when crypto hits and the United States government's controlling it.
Exactly. And
you were right on the money with that. What's your feel on the crypto affecting the predictions for the markets?
Crypto has become cryptocurrencies now. Okay, I'm gonna back up what I personally think crypto is. You're gonna get a lot of hate mail. Probably.
Oh, I got hate mail from the first one, so bring it, all you crypto.
I believe it is a risk asset class. It's a trading vehicle. Commodities, gold, crypto.
Is it managed futures? Our old friend managed futures. So would it fall in the managed futures category? Is it even more risky than that?
Way more risky
than managed futures.
Did you ever see managed futures go down 40% a month?
No, but that's because our boy John Henry was running the show. You know what I'm saying?
That is true.
People that know futures, they know who John Henry is. He's a dude, man. He is a really smart guy. And when we were at Morgan Stanley together, we had some managed futures with some specific clients that could handle it. But what you're saying is crypto is a whole nother game of volatility.
Crypto, and by the way, I saw Anthony Scaramucci, I think it was, who's
I saw that
now, and he was on CNBC yesterday, and he's changed his tone from being a currency to it is a technology play.
That's what you said. You said blockchain. It's not the crypto, it's blockchain.
So he says
they need to be sending you money, Owen. These people are riding your coattails.
He said it's a new asset class. I say it is a risk asset class. It has no stored value. It's a way for people to it's a way for people to trade something.
But getting
That's
back to
my opinion.
how it affects markets, stock market, etc. When we talk about, me and you off air a lot of times, about the unwinding of crypto, people not knowing what a margin call is the worst call you could ever get, because you got to come up with money immediately and there's no excuses. Will the unwinding of crypto, which is going to happen, okay?
Yes.
Will that be a wrench in the engine that Dr. Siegel and Byron Wien and the smart guys in the room like you can't predict, and it might throw things off a little bit?
To the contrary, I'm gonna give you an alternative scenario.
Okay, good.
How much money, you've seen it, Stan, I'll let you comment. How much money do you think has gone into the crypto market in the past 3 years?
I couldn't even guess. I'm assuming trillions.
Trillions. And when it went into crypto, where did it not go?
Yeah, that's a good
It didn't
point.
go
It
into
didn't go to the
stocks.
market. Yeah, it didn't go
So
to the market.
now when people are pulling back the reins and saying, maybe I shouldn't take my $1 billion and buy Bitcoin, maybe I should buy the S&P 500, maybe I should buy Microsoft, maybe I should buy Pfizer.
That's a really good point. The money's got to go somewhere.
Money's going somewhere.
Even if it's half the amount of money. So let's just say there's 3 trillion in crypto, it corrects, and now it's worth $1 trillion. Trillion still got to go somewhere, right?
It's new money that I'm thinking of. I think less new money will flood into it. That money will go somewhere. Interestingly enough, guess what asset class has seen the most debt influx in the past quarter? Gold.
Really?
Gold was dead. Gold was dead last year, right?
What's your thought on that?
It is rich money, high net worth money is financing. I need a hedge from stocks. I'm not going to buy crypto. I'm going to go buy gold. That's my opinion.
Well, and I read the other day, this might or might not be true, because at this point, our media is suspect at best. But I did read that 40% of all crypto is controlled by 1% of the people. Mm-hmm. So, it's closely held, which means that the other 60% are wandering ambiguities that probably shouldn't have bought it in the first place, right?
Correct.
But that's going to happen. Do you see crypto correcting? And I don't know what the definition of a crypto correction is.
It's already happened.
So you think the correction's already happened with crypto?
I'm not saying it's found the bottom. It has happened. It's down 40% is a correction, Stan.
Valid. Under your definition, it is a correction. But just gut instinct with me and discernment, I think it's got a ways to go. They got to flush out the weaklings, and they will be flushed out. And hopefully for the listeners out there, you're not a weakling. So, and it's in proportion. You said a long time ago, there's nothing wrong with investing, and just in proportion, please don't go all in. But you're saying that the market's going to absorb it and actually benefit from a crypto correction. So it is going to happen. It is going to be ugly. It is going to be volatile. But at the end of the day, it'll be okay.
Yes, I believe that. Very much so.
And that's interesting. And I think going back to the original thought you had last year when we had you on the podcast talking about blockchain technology is the investment. That's where you've done your work with your clients' money, in looking for those opportunities, not crypto, but blockchain. Blockchain's the real deal.
Not only is it the investment, it is the vehicle that's going to make your companies that you own more profitable, more efficient. Mm-hmm. It's the new technology.
No, I agree with that totally. Tell me about, and I hate to parrot what media says, but I went to the grocery store last night, Owen, mm-hmm. and I'm a Southerner, you know that, and that's why you love me. But I was looking for saltine crackers, Owen. There was none on the shelves. We're living in a world that I never thought would exist, where when I go to the store, there's a doubt in my mind that what I'm looking for will actually be there. I know we were spoiled, but I cannot. I literally looked at my wife last night. I said, there's no saltine crackers. Seriously, how's that even possible? How do I have peanut butter and crackers? But my point is about the supply chain issues. Mm-hmm. Give me your insight into that, getting rid of the media hype. What's the real deal on this supply chain stuff that's going on? Because it's real to people like me that need saltine crackers.
I'm going to dip my toe into politics here.
Please do.
The start of the supply chain problem is the United States and other developed countries deciding a decade ago that they could make 10 cents more a share if they outsourced all their production to China.
I agree.
So when everything you import into the United States is in another country, in this case China, and they have a disruption, which they're having from the pandemic, from demographics, and then it piles up and you have shipping issues in the United States and the ports, and it is a domino effect. But it starts with the fact that we have outsourced our raw materials, our manufacturing chips, technology chips for cars. They're in China.
I blame both parties and the Chamber of Commerce.
Yes, there's lots of blame for everybody.
I mean, but both parties, and this is a greed play that's affected the country as a whole. But I think do you see the pendulum swinging a little bit? Because labor, the workers seem to have a little bit more power here, Owen. I'm not sure if that's good or bad. I actually think it's good for the workers. I want them to make more, but obviously it's the bottom line for the suppliers and the manufacturers. But if I was running for president, Owen, and I should, I would be pounding the table and doing the tax incentives to keep the manufacturing here, because that's what you're saying is we've done it to ourselves.
We've done it to ourselves, but that's all right. I'm gonna give you another scenario. 3 years from now, the pandemic was an ugly memory. 4 years from now, and let's think back to 1975, which you remember. And
great music in 75, just to let you
know.
Great music. I mean,
Physical Graffiti came out.
Exactly. Go ahead. I'm sorry.
And we've got wage inflation. We have strikes. We have disruptions of supply. And the CEO says, wow, China's got their stuff together. Why don't we just outsource it back to China again? And my concern is corporations, absent political. We need something from a national political consensus that incentivizes companies not to seek the cheapest source. If it can make your earnings better and increase your supply because you got disruptions in the United States, 5 years from now they'll go back to, it may be Vietnam, it may not be China.
Oh, it'll be some third world country, because we both grew up with this. We're from North Carolina, both of us, God's country, by the way, if you're keeping score. And we saw this happen with the textile mills, because all of our families worked in the textile mills. Exactly. Owen and I did not come from the silver spoon, gold spoon. We came from poor, middle class, hardworking North Carolina, and all of our family tree was working in some type of either textile mill or manufacturing mill. If you go back to the lineage, my grandfather, your grandfather, I mean, they were working on looms, and then all of a sudden they, went to China and it was over. I think that maybe this time, hopefully we'll learn a little bit better as a country that we cannot have it all sourced overseas. It's dangerous.
I hope so. But I'm not optimistic about it.
Well, as long as the markets are quarter to quarter on earnings, and people look at it like that, then they're always going to be looking for the third world solution for labor. In most cases. Getting back to the markets, historically, and we're doing this in 2022, we're going up to the midterms, which hopefully no one's going to watch because it's going to be horrific. But what happens historically during midterms with the markets? Or have we seen this combination of low rates getting ready to raise interest rates, volatility in the markets, and midterms? What's your prediction for that?
I do not have Stan, I'm going to be very honest with you. I don't know the answer to that.
I love that. See, Owen's going to tell you the truth. So what's your gut feel? Just, you don't have an answer?
I'll ask everybody to look up this name, Frank Luntz, Luntz.
I don't like him.
Well,
I'm sure he's a nice guy, and I'm sure his wife makes a really nice peach cobbler, but he's the pollster, right?
He's not a pollster. He does focus groups. And in fact, he called Brexit.
Tomato, whatever.
He called Brexit. He called Trump. He called Trump again. He called last midterms. He's very accurate. Right, like it or not, he said that his group showing, if you look at news, everybody's focused on voting rights, whether right or wrong, but January 6th, they're overlooking, he says people are concerned about inflation.
Absolutely.
And that's what's driving it, and it's not being addressed. And he says that it's almost a certainty that you'll see the House of Representatives go to the Republicans and the Senate, a thin majority, go back to the Republicans.
Let's just hope they have a plan. On a side note, I think we all can agree, listeners, Owen, everyone, that Frank Luntz has a head that will not accept a baseball cap. So I can never see him.
That is true.
He's got one of these weird, I mean, I wear a baseball cap, but I wear it with, I wear it suave.
You look good.
I thank you very much. I mean, it's natural, but but Frank Luntz is one of these dudes that if I ever saw him with a baseball cap, I would like run up to him and rip it off his head and say, "Do not do that. You look like you shouldn't be doing that." I was going to say something that was probably a fin, but it is.
He's been accurate. I do listen to what he says, though. I have to say, I don't like him, but I do listen to what he says.
Yeah, he's messy, as they say. He's messy. Tell me about bonds, Owen Schrum.
Yes,
you taught me everything I know about bonds, which is a crap load, and you've forgotten more than anyone else will ever know about them. What's bonds coming up now? This could be fun or not fun.
Not fun. Of the five people that we followed closely, there was only one item where there was 100%
consensus.
And that 100% consensus was that anyone who owns bonds that are longer than 1 year in maturity, which all funds are,
yes,
target date funds, are going to have negative returns this year, negative returns next year. Dr. Siegel says they're going to have negative returns for the next 5 years.
And if you have a closed-end bond fund, that baby's probably margined and leveraged.
Understand, a quick lesson, make it real simple. Picture a seesaw, stick your arms out. When interest rates go up, the value of your bonds will go down on the other end of the seesaw. Bonds have been in a bull market since 1985. That bull market is over. If you own bonds, and most bond funds have maturities of 10 years.
At least.
That means 10 years. That's your average duration in a bond fund. That means when interest rates go up 1%, you lose 10% of value.
By the way, when you did that arm thing for the people on the podcast, he did like Owen was flying a plane. And there's instinctually, I wanted to start singing Wheels on the Bus Go Round and Round.
It was a seesaw.
I understand, but I just was thinking, wheels on the bus go round and round. No, but so you're telling people that have bonds, bond funds, closed-end bond funds, you might want to exit the building?
I think you need to talk to your advisor. Lawyers are over my shoulders.
That's what I'm saying. That's a compliance trap. Yes. Call Owen Schrum. And for the people that this is Owen Schrum. He is a fantastic money manager. If you're looking for that, fee-only guy that is going to shoot it straight, and what I really like about what you do is you manage risk. Can you go into what that means in 2022 to manage risk on a portfolio?
For the old school is diversification accounted for 80% of the return of your portfolio. And we got away from that as tech stocks have gone through the roof. And to make money, you had to own, the names, the Teslas, the Amazons.
Sure.
And people were the movie theater that people were buying and on Reddit. I forget the name of it. You get the idea. And we're going back to an era where diversification is king. You need to have different asset classes. You need to have different sectors. You need to have different size stocks. You need to be diversified. Diversification doesn't mean owning 5 different mutual funds, because those mutual funds probably own the same stocks.
You're talking about asset classes. Now, diversification, that means I have to wear bell bottoms again, Owen, because I look good in that.
Diversification means you might own cash, you might own inflation protected securities, you would own annuities, you would own large stocks, value stocks, international stocks, real estate, And there's these programs that will run that give you, it's called the efficient market, the efficient frontier, modern portfolio theory, won a Nobel Prize in the 60s. But there's a formula, there's a computer program where there's a perfect mix of asset classes for someone's risk profile, their individual risk profile. And if you get that right balance, you minimize risk and maximize the return for the risk that you're going to take. And in my opinion, you achieve that by proper diversification. And as always, dividends and cash flow are king.
Well, and everyone's different. There's not a cookie cutter. I mean, when a client calls you, and I know this for a fact, I mean, it's customization. I mean, you're listening to them, you're asking the questions, you're qualifying them, their goals, their risk tolerance, and then you're putting together a one-off for them, each specific
Correct.
person, and then you help manage that for them ongoing. But that's I think the value of a money manager like yourself, I don't know if that's the correct description of you, but an expert. I think the experts are going to divide or move away from the weaklings and the beginners. You're going to have someone really good like an Owen managing that side and looking at it all the time, because it's going to be choppy for the next couple of years, right?
Yeah. And Stan, I also want to add something to you. You have really good people that listen to your podcast, well-intended. They want to learn something, and I want to give them a takeaway of something they may not have thought of.
Okay.
When we mention that bonds, in our opinion, are going to have negative returns, I know a lot of people says, I don't own bonds. So I'm going to ask you to stop for a second. Do you own a 401k? A lot of people do. Guess what? By a large factor, the main thing that people invest in a 401k in, target date funds.
Target date funds, yep.
Target date funds, look inside of them. That'll just be my hint.
Exactly.
Look inside, they have bonds. That's what makes them a target date fund. And a lot of them have long-term bonds. So you need to look inside your target date funds, or have your advisor run a report on the target date funds and find out how many bonds are in their portfolio and what the average maturity is of those bonds and their target dates. Don't let this mess blow up your retirement just because you weren't aware of what's inside of your 401k plan.
Well, and we're not poo-pooing on bonds. That's a technical term, poo-pooing. But people have to understand there's more bonds out there than stocks, and bonds are volatile.
Correct.
People have an assumption sometimes that bonds are safe, and they can be if done correctly, but they're not all the time safe. They're not all the time liquid either. I think liquidity of bond holdings is a big one as well. And just because you're buying a bond mutual fund or buying an ETF doesn't mean that you're slaying it, right?
Correct.
But didn't you tell me a long time ago, and I remember when we were at Morgan Stanley, and there, big municipal bond buyers, we love that. You taught me everything I need to know about munis, but aren't the institutions just coming in and buying those things lock, stock, and barrel? And what's happening in the muni world?
Well, actually, one of the biggest declines we've seen in the past 6 months has been municipal bonds.
Really?
They've gone down, and
why
they've
is
had
that?
Returns because interest rates are rising, and your average municipal bond's a 30-year bond.
That's valid.
Period. That's a simple answer. And don't need to be.
But if you take that bond to term and own it for 30 years, you're fine. But if you look, the valuation underlying that bond is going to fluctuate. So that's the reason you'll see bonds, par on a bond is 100, and you'll see one selling for 107 or 106. People need. I mean, here's what I tell people all the time. And this is the correlation. I'm Stan the Annuity Man. There's no need for you to dive into annuities, even though I have 500 videos and podcasts and 7 books. I'll send you all those. You can do your own research. But at the end of the day, you need an expert. Same thing for the risk management side, equities, bonds, ETFs, whatever. You need an expert. Yes, you can do your own research. But in a fee-conscious world, I understand people don't want to pay fees and they want to strip fees out. I get that. I mean, I really do. But there is a reason that people with real money have advisors and experts and specialist doctors and people like that, because they're specialists, right? Are you seeing people a little bit more open to having an expert like you manage their money because they see volatility coming on the forefront?
Interesting question. And here's what we're seeing, and it's what we've been seeing. And it's the exact opposite of what most people would think. People with high net worth people are on a large percentage hiring people to help them manage their money.
Mm-hmm.
The more you go down in the net worth line, people just starting out without, all money is important. I'm not diminishing.
Oh, we both came from no money, so I mean, we're those advisors that came from poor. Actually, the reason that we're advisors, we couldn't figure out why everyone else had money. We didn't. Honestly, we've had that discussion.
And then we became advisors and saw what other advisors were doing to people.
Exactly.
So that's another podcast.
That is. Oh, God.
But what we're finding is as you go up the net worth curve, that the percentage of people hiring advisors go up.
And it really should be the reverse.
Yes.
It really should be.
Yes.
I mean, it's sad, but it should be the reverse. And I have nothing against do-it-yourselfers because, you know, annuities, because they're contracts, is kind of a do-it-yourself thing. But stock market stuff is not do-it-yourself. Okay. In a raging bull market, it can be because it's a raging bull market. But what you're saying in your outlook is going forward, it's going to be bullish, but it ain't going to be raging bullish, right?
I'm not even saying, depending upon your time. If we're looking at 20 years, 10 years, it's going to be bullish. If we're looking at 1 year, I believe it's going to be bullish. We're looking 2, 3, 4 years. I'm not guaranteeing that. I'm not guaranteeing anything.
And I think that's important because, as I always tell people that are retirees, already retired, thinking about retirement, trying to spell retirement, looking at retirement on the horizon. I mean, you need to focus in on, you're at lap 3 or 4. Do you want to take risks? You need to manage the risk. You don't have time to go backwards as much as you did when you were in your 40s. So I think it's even more important to look at risk and managing risk, or in a case for annuities for principal protection, like to make them transfer risk.
Yes. The most critical time, sorry to interrupt, the most critical time investing in your life is the 3 to 4 years before you retire and the 3 to 4 years after you retire.
That's a really good statement.
Give you a case in point. John Doe and Jane Doe. John retired with his $1 million on January of 2007 and started taking income on it, invested it, going to take it out, and then found out in 2009 that $1 million was worth $600,000 and he had to go back to work. Jane invested 2009. 2 years later, her $1 million was at 1.5 million. Just by luck, just by bad timing or good timing. You can't take a chance on luck when you're retiring. So the most important time to make sure you're managing risk in your money is a couple of years before retirement and a couple of years after retirement, because you can't afford to just have bad luck.
No, absolutely. Recently, I had Wade Fowle on the podcast, and people don't know who Wade Fowle, P-F-A-U, pull him up. Smart guy. Doesn't sell anything, but he writes books and talks, and people listen to him. Oh, and he destroyed the 4% rule. He factually destroyed it. He threw it under the bus. He drove over it a few times, and then he did it again based upon his research. I know that when we were in Morgan Stanley, and Owen owns his own firm now. It's Schrum, S-C-H-R-U-M, PW.com. Please go there. Do you agree with Wade on the 4% rule?
Yes.
That dog doesn't hunt anymore?
Well, the main reason that dog doesn't hunt is because interest rates have fallen. When the 4% rule was in place, you had a predictable return of 5 to 6% on bonds and cash.
Well said, my friend.
I mean, Dick Marsden at Wharton has done so much work on that, and he used to preach the 4% rule even to institutions. He says, no, you can't do it anymore. And one of the main drivers, again, is you're not getting that return on your safe assets that you used to.
That's true. And I also, Wade's comment too was, when the 4% rule was initially adopted by the industry, and it is such a hack way to do it. I mean, if anyone's saying, well, we'll just use the 4% rule, that is a hack. You need to walk out of their office immediately. It's because a lot of the international markets were not taken into account of the 4%. No, it was more of a domestic U.S. market thought, but it's just kind of gone by the wayside. So yes, it's wonderful that you could peel off gains or interest and not touch the principal, etc. That's perfect world. I hope it happens for you, but yeah, in a bull market it could, but in a choppy market it can't.
Particularly when you're taking immediate with distributions from your money. Because
Exactly.
if you're in a down market and you keep taking money out and you're taking principal out instead of returns, and then when the market turns around, you have less principal working for you.
I know that you have been so gracious to give us your outlook on things today. Is there something on your site that shows that as well? Do you have something written up? Do you have something you can send to people?
We have something we can send to people. It is sitting on the compliance officer's desk right now to put it on our website. That's the world we live in. And
Yeah. So in other
however,
words, go to the site, sign up for it. You'll get it to him. And if you want to have a conversation with Owen, and he has associates, but because, I want you to talk to the people. There's a lot of people that heard you on the previous podcast and talked to you and became clients, and they really like your cadence and how you do things. You'll give them the oversight as well. But I understand the compliance issue. I thought that might be the case.
That's just a post on the site. Email Stan. I'll have it to you in 2 hours.
There you go. I mean, it's Stan at theannuityman.com. What else? I know there's a lot of things happening in the world. We're looking a little bit myopically at markets and bonds and ETFs and things like that. But we're living in a wild world. Once again, at the time of this taping, there's chaos and potential war on the horizon in Eastern Europe, etc. What is that another thing that that could throw things out of whack if that happens, or what's your take on that? As there's a lot of moving parts. Interest rates potentially rising, crypto declining even more and unfolding. War. What's your war take on the markets?
It is, in the short term, it's going to increase volatility. And Byron Wien, and by the way, if you type in my name, we've mentioned, and Stan mentioned Byron Wien, a wonderful man and a very, very smart, and a very wealthy man. I did an article for U.S. News and World Report on Byron Wien. It's a good read, and there's some wonderful tidbits of knowledge. I bring him up because he said the greatest time to invest ever is climbing the wall of worry. He invented that term. Markets will sell off over things like Ukraine, oil embargoes, and all they're doing is transferring money from people not being very smart to people who are smart, meaning some people sell and some people's buying those assets at cheaper prices.
Climbing the wall of worry.
His number one indicator.
Wait a minute, wasn't that an album by Mott the Hoople in '74? Climbing the Wall of Worry.
Or was it Pink Floyd?
People that Google Mott the Hoople for anyone. I mean, Owen and I are music people, but Climbing the Wall of Worry, which is a contrarian way of a very smart way of saying, when the shit hits the fan, turn the fan on faster.
And when everybody's buying, maybe think they're overpaying for it. His biggest indicator for being wealthy, and he's a wealthy man, was the uncertainty versus sadness. When people were optimistic, he sold. When people turned, he measured sentiment. And when sentiment turned below 50%, he put every buy signal in the world. And when investor sentiment got over 80%, he started selling. That's
common sense contrarian strategy right there. Yes. Common sense.
So that's how I'm answering. However, we're historically, be it Lebanon, Africa, Ukraine too. This is the second time we visited Ukraine.
Yeah.
We are always going to have these pop up. Markets always react negatively, and they always go back. Now, if that turns into World War II, I can't predict that. But that's called a black swan event. I can't predict those. But nobody can. But if we have your international skirmishes that happen, markets do react in the short term negatively, and oftentimes they're opportunities. Would you rather buy X? Would you rather buy X stock at 120 or 2 weeks later at 100 because it went down short term because of an international event.
Which begs for you to have someone like Owen manage either all or a portion of your money, just because you need expertise in these types of markets. He's been doing this a long time. I mean, a long time. I know he looks vibrant, but he's old. I know that for a fact.
I'm old.
He is old. I do this with every celebrity guest I have on. I've done it with you in the past. I'm going to do it with you one more time.
Yeah.
Words of wisdom, mic drop moment, Owen Schrum. Leave some nuggets of wisdom for our viewers and listeners before we close this thing out.
Do not invest your hard-earned money emotionally. Do it stone cold, non-emotional, talking to an advisor or a trusted person. Do not let emotions factor into your money.
Sociopathic investing.
Behavioral finance is the term now.
I'm always pushing that envelope, you know. Owen Schrum, good friend, you know, your family to me, but you're also one of the smartest guys in the country when it comes to managing money, insights into the market, well respected. He's an icon that if you don't know about him, you do now. And I would encourage you to go to Schrum, SCHRUMPW.com. We'll have this, we'll have a thing on our site, page on the site for him. But Owen, I thank you for joining me, and I thank every single person out there listening on all the major podcast platforms and watching us on the Fun with Annuities YouTube channel. And I will see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.